Hello traders, James Stanley with StoneX and Forex.com. It was a big week for the US dollar. USD broke down on the back of the FOMC rate decision, and I think that happened in a way that you were probably expecting. The Fed was not as dovish in their forecasts as what rates markets were looking for. But the announcement of Treasury bill purchases and a key phrase from Jerome Powell in the press conference seemed to really take over matters. And that puts even more focus on the CPI and NFP report that's coming up. With the U.S. government shutdown, there's been a bit of opacity around data. But the phrase that Powell said in the press conference that really started to drive USD weakness was that he thought that the U.S. was losing about 20,000 jobs a month. So that puts even more pressure on the non-farm payrolls report on Tuesday, and that could have a big bearing on USD price action. In this video, I wanted to look at the dollar from a few different perspectives. I wanted to look at the dollar from a vantage point of strategy, and as usual, I want to try to take a balanced approach around the dollar. And like we saw last week, even if the dollar is showing relative weakness, there could be a case for strength elsewhere, given those cross-current flows. I'm going to look at that via the dollar-yen and another setup a little bit later. So let's get to the chart, start chopping this up, and look at where we're at. So again, first and foremost, in the USD, got to call this what it is. It's lower lows and lower highs. We had failure from bulls to run with that breakout at 100.22. That same support that was in play last year has ultimately proved to be a brick wall of resistance. This sets up a double top formation. The way a double top works is it doesn't trigger, it doesn't activate unless you get a break of the neckline. The neckline is the low between the two highs, or the top. That break of the neckline happened right in here and got a push with the FOMC rate decision. But what makes this key is the projected move. The double top projected move involves taking a measure of the top to the neckline and then projecting that below. In this case, that projects to a move of 97.62. It's a big spot because of what it's near. If we take this gap from earlier in Q4, this was a gap I was looking at in prior videos. I was looking at this as a form of invalidation on the long side. This gap still has not yet been filled. Markets have a tendency to want to fill gaps. Not every gap gets filled, but especially in currencies, they have a tendency to want to fill the gap. It just might not be instant. It might not be automatic. And again, not all gaps will fill, but this is like a beacon point for support potential if we do see that continuation move. Now, the way that the calendar is set up for next week makes this, I think, especially interesting because we have NFP on Tuesday, CPI on Thursday. It sets up the situation where there could be a possible 1-2 punch. Like if NFP comes out weak and USD bears get the room to run. Like again, the thing that really sent this spiraling lower, and we could look at this on a 5-minute chart, was that comment from Jerome Powell in the press conference where he said he thought that the U.S. was losing about 20,000 jobs a month. Initial reaction to the FOMC statement is right here at 2 p.m. You see that was lower, and again, the Fed wasn't as dovish as what markets wanted to see, but the Treasury bill purchases, I think, buffered that to a great degree. Early in the press conference, the dollar was actually up on net until Powell had that line about 20,000 jobs lost. And that's what sent the dollar spiraling lower. I think this is driven by the expectation that if there is legitimate labor market weakness, the Fed is not going to wait around. They're going to continue to cut, even if inflation is a little bit higher than what they want to see. That's going to help the Fed stay in a dovish posture. And as a case in point, we could look at rates markets right now. Even though the Fed said they were looking for another 25 bips in cuts in 2026, rates markets are already looking past that. This is the expectation for 50 bips in cuts, currently showing at 32% probability. A week ago, that was 30.1. Even at 75 basis points, currently at 23.9. A week ago, that was 23.7. So we've seen 50 and 75 bip cut expectations increase, even though the Fed said they were only looking for 25. So again, it's almost like the markets are looking past what the Fed said in the dot plot matrix, and they're instead focused keenly on this NFP report on Tuesday to see how weak the U.S. labor market just might be. And again, from the daily chart of the USD, that sets up for a pretty interesting 1-2 punch, given that NFP is on Tuesday, CPI on Thursday. Now, in the dollar, if we do see dollar bears stretch and get down for that support, another item of interest is RSI. We're not currently in oversold territory, and I don't look at oversold or overbought as like an automatic signal. But it is something that makes it tougher to chase and sets the door for possible reversal or pullback types of setups. The last oversold signal that we saw back on July 1st was near a pretty significant low. But to buffer that, and just in the effort of showing this in a balanced manner, the previous signal before that, pretty messy. It took a while for price to actually begin to turn. So again, if it goes into oversold, it's not an automatic long or reversal setup. But if this is happening near support and we do see the move starting to stall, and if there is a CPI report coming out a couple days later, that is something that could start to build the backdrop for USD strength. But again, as usual, we're talking currencies here. Currencies are unique and that they're the foundation of the global financial system. The only way to value a currency is with another currency. So if the dollar is going to reverse, if the dollar is going to show strength, it's going to need some help from somewhere. I'm going to get to dollar yen in a moment. First, I want to look at a couple of dollar weakness setups. For dollar weakness, I've been following pound dollar as what I consider to be the most attractive venue for that. And the reason is really very simple. The structure has been cleaner on the long side. We have this swing high from mid-November, and notice we broke above that a week and a half later. Got a higher high, and then a higher low, and higher highs and higher lows continued. In euro, we didn't quite have that same structure build. That's the mid-November swing high. We got above it briefly in the prior week, but then we just kind of pulled back and stayed below it. It wasn't until this week, it wasn't until the Fed this week, that Eurodollar finally broke out and started to retake control. Now, I looked at this in an article on Monday around Euro Pound, essentially highlighting the fact that we might be in a spot where the euro could start showing some greater strength. And sure enough, walking this from tops down, we had that support build over multiple days, and you could see Thursday, Friday, euro bulls have started to take over a bit more. So we could be at a paradigm shift here where Eurodollar begins to look a bit more attractive for USD weakness than pound dollar. I like both of them for USD weakness at this point, and if I'm looking for USD strength, I think there are better avenues to do that. But in Eurodollar specifically, I have this at a really big spot. This is a Fibonacci level that I've been talking about for most of the year. It's the 2021 to 2022 major move, which is validated by this swing high in 2023 at the 618. A good portion of last year, we saw this range build between the 50 and the 38.2 retracements, and then earlier this year, it was the 23.6 that marked the low around the 102 handle in both January and February, ultimately leading to that reversal. But since this zone has come into play, back in late June, early July, bulls have been stopped dead in their tracks. And notice, there's been a significant amount of grind on either side of this thing. But you can see very cleanly from the weekly, where we have this resistance holding very well at 117.48, and then showing a lower high at 116.86. Shorter term, you go down to the daily chart, and when we looked at that dollar chart from early Q4, when we had the grinding build of higher lows with that gap from early October, well, right in here, there's a key component of that. We had continued holds of resistance at 117.48. That's 5 consecutive days. You can see those upper wicks on the daily as sellers just coming in to swat these rallies down. Ultimately, that leads to a lower low, and then we get a lower high right at 116.86. 115 was the spot that ultimately crushed the bears. And I covered that in these videos for StoneX TV. I even still have this chart up that I had showed that it takes weeks and sometimes even months for 115 to get taken out, even if there is proper fundamental motivation or drive, like there was in 2021 leading into 2022. But ultimately, that zone could not get taken out on this most recent instance, and currently, we're seeing a higher low off of 115, pushing to a higher high, and the door is open for bulls to take their shot. If we see the dollar continue to drop, fill that gap, and continue to run, even if a bit oversold, Eurodollar could have something to say on the long side. But you can see right now, we're at that 117.48 level. That held resistance on Thursday. It's still holding the high into the weekly close, but bulls haven't given up yet. 116.86 is now higher low support potential. Let's go down to this chart where I have a bit more detail. 116.86 is now higher low support potential, and then it's this zone, the same zone of lower highs from October and into November, that is a key support zone. It's 116.56 up to 116.69. And I'm considering this as invalidation for euro. This is the group of swing lows off the daily that had formed ahead of the FOMC rate decision. It's at 116.16. If bears take that out, that's where it's going to start to look like bulls have lost control, and then that's what I need to see taken out to start getting back on the short side of the pair. It runs from 115.93 to 116 flat. But that's the situational setup that I have in Eurodollar. Pound dollar, I still like it for USD weakness, just not quite as much. And the reason could be best explained by the past 2 days of price action. Like I showed you in Eurodollar, we had that strong Thursday, and so far a green bar today. We could just look and compare right now. Right, again, USD is the denominator in both of these quotes, but you look at Euro, strong and strong. And then you look at pound, and we're down on net over the past 2 days. And we had an indecision candle yesterday, right after that Fibonacci resistance played. This isn't quite to the degree where I'd want to start getting bearish, but the claim for strength, I think, is stronger in Eurodollar at the moment. Now, the setup I looked at in the Tuesday webinar, still holding. 132.87 held as support beautifully, and that volleyed right into that fresh high. Even the pullback of this has so far held support right at a big area between like 133.53, 133.71. And there's another support level that could hold right there at 133.28. But that's what I'm looking at for invalidation right now on cable. So I have this on a little bit of a tighter leash than I have on Eurodollar, given that it has stalled or slowed a bit over the past couple of days, but still following this one for USD weakness. For USD strength, however, and again, this is why I do USD strategy in the way that I do. Because at the end of the day, the dollar is going to be unpredictable. I mean, all markets are unpredictable. But the dollar is going to be unpredictable. And if I could find areas where dollar strength has shown a little bit more prominently, then that's where I want to push for USD strength. Or where USD weakness has shown a bit more prominently, as it did in cable until the past couple of days, I want to push USD weakness there. For USD strength, I'm still following dollar yen, where even though that USD weakness pushed breakouts in Eurodollar, breakouts in pound dollar, it was a higher low this week in dollar yen. And I looked at this in the week ahead video on the USD last week as I was looking at that. Then we had a beautiful hold of support. We had the build of this falling wedge. That falling wedge broke out on Monday. And dollar yen went vertical for a little bit. FOMC rate decision, however, turned things around. But 155 is that price that was well defended by buyers on the pullback. So if I'm looking for USD strength, this is still a spot that I want to do it. Now, if we're looking to remove the dollar altogether, I think this yen weakness could also work well elsewhere. So we could take, again, some of these cross-current themes and combine them together. So like Euro yen, for instance, we could take that strength that's on full display in Eurodollar and now mesh it up with the Japanese yen as opposed to the US dollar. And case in point, we have a fresh all-time high that's printing right now in Euro yen. This was a setup I looked at in an article earlier in the week. Also looked at it in the webinar. But look at how cleanly that played. That 182 resistance came in as support multiple occasions and then rallied on up. Fresh ATH. Pound yen, similar. But like I said a little earlier, I'm starting to like euro for strength a bit more than sterling. But in pound yen, I got this one at a really big spot of support right now. This is the 2024 swing high. It's right at like 208.12. We set that fresh 17-year high earlier in the week, the pullback of which so far has held higher low support. But you can even see this off of a shorter-term basis where that trend has held quite well. So I could essentially remove the dollar from the mix, take the British pound strength that's shown in cable, the USD or the Japanese yen weakness that's shown in dollar yen with that 155 hold, and focus it right there on pound yen instead. Both setups that are still on the radar for next week. One last one, dollar CAD. The reason I wanted to look at this one is because this is a pair that has been in a pretty constant state of flux over the past couple of weeks. Now, in Q3 and Q4, this was one of my preferred USD strength vehicles. And the big reason is that same deduction. Even though the dollar was pushing down to a fresh low on day one of Q4, or excuse me, day one of Q3, dollar CAD was holding a higher low. We had 137.50, a major price that came into play in May to hold the lows, led to this bounce up to 140. And then once sellers were ultimately able to get it below it, sets horizontal resistance for like a month and a half. Along the way, we get these higher lows. That's an ascending triangle formation, often approached with aim of bullish breakout, which is precisely what hit in July with a big boost from the FOMC rate decision on July 30th. Now, it was the NFP report 2 days later that reversed DXY, reversed the dollar, reversed euro, cable, etc. I mean, that was a notable event across macro markets. But that move in dollar CAD was merely a pullback to support a prior resistance. And I talked about this quite often in webinars, where it was all about the bullish anticipation that was showing at those lows. And I can even show you right here, where we could take the swing low from that instance, where we held that support at prior resistance, 137.219, and then the recurrent test, 137.267. And then notice this, 137.268, literally 1 pipette higher, but it still shows that bullish anticipation where buyers were unwilling to allow price to pierce that prior swing low. And lo and behold, that was when the Fed started cutting rates on September 17th. That led to the ultimate breakout that pushed through the 140 level. But bulls faltered. Couldn't quite get a test of this resistance turn support, 41.51 to 41.78. And that's where things started to shift. Now, in the webinar a couple weeks ago, I said I had this one in the penalty box. And the reason why is because of what was happening at that 140 level. If you look at the way 140 played as resistance back here in May, it was essentially a slingshot move where sellers defended this well and then pushed it down into a fresh lower low and continuation of trend. In this case, we pushed up, we broke out, we saw defensive 140. We saw a bounce, but this time it didn't get a higher high. There was no continuation of trend. And then when we retreated back to 140, we pierced below it a little bit more. You look at this on the 4 hour, it shows very clearly. We had that first breach of 140, and then it became resistance. And it was in that webinar on Tuesday when I said I have this one in the penalty box. And then it continued to break down. But here's where the proverbial plot thickens. We're now back down towards that 137.50 level. It hasn't quite come into play yet. It doesn't quite suggest that this is ready for reversal yet, but it could be soon. Because ideally what I'd want to see is I'd want to see an intersection. I'd want to see a rejection at that support zone. Like I'd want to see sellers test it, but then buyers come in and take them out. I'd like to see this close as like a hammer type of candle. But there's also oversold on the daily. And the last oversold we had back in June, right around the time dollar CAD set the 2025 low. So again, I don't look at oversold as like an automatic long setup, but it is something that makes it tougher to chase. And that could be the early stage or the early opening to a long setup or to a reversal. And if we see US data hit next week, especially if it's that 1-2 punch where we get weakness on the back of NFP and then strength on the back of CPI, dollar CAD could be of interest for reversal setups. That, my friends, is what I have for this week. That's what I have for the US dollar as we go into a couple of really key data reports. And as always, thank you for your time and happy trading, ladies and gentlemen.